Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really happy to have with me once again, as almost every week, Michael Oliver is with me. Thanks for joining me again, Michael.
Oh, happy to be here, Jay.
Always good to have you here, and we always should tell our listeners that your website is olivermsa.com, olivermsa.com. Go there to learn more about Michael's work, and if you are an accredited investor, a serious investor, you may want to consider signing up for his letter. Michael, yesterday you showed your subscribers a chart that looked pretty interesting on natural gas. I mean, natural gas has not been some place you'd want to be long on, a market you want to be long in for some time, but it is looking like a breakout, huh?
Well, actually, we registered a breakout in June as it came back up through $2.40, and we had an objective of $3.50. Now, these are all numbers that are pretty low historically for natural gas, so it's not a big deal, but that's a 45% move. Mm-hmm. And we're toying with getting to $3.50 now. So that was a trade. It was positive direction for natural gas. I think natural gas will go higher in the long run, but right now we're just looking to take that bite. You buy it at $2.40 and you sell it at $3.50, and you get 45%. And some people like to get that, over a period of 5 years in the stock market. If it can get there, it will have done it since June. So it's very close right now.
Speaking of the stock market, what are the chances of getting some kind of a return like that going forward?
I think nil. If you drop, today, let's say the low today was just below 2,200. That puts it about 4% higher than it was 2 years ago. So you put that in perspective. And if you drop 4%, you're back to where you were 2 years ago. That's back under 2,100. The stock market, S&P, let's narrow it down to that one, which is highly unrepresentative of other developed market indices, by the way. Gold and T-bonds all seem to be very linked, especially on the near-term basis. And we've had a lot of reports on this. T-bonds and gold are in sympathy. They both got whacked recently, and they both look to me, to our work, like they're ready to turn up again. And I think that will be coincident with the stock downturn. And so if you invert all the momentum studies that we do of gold and bonds and flip them over or put them in a mirror, you're going to see an S&P oscillator, is what we're saying. And so I think that's where we are right now. We're trying to top stocks, bottom T-bonds, and bottom gold. And I think the rally that could come out of those two markets, T-bonds and gold, could be pretty sharp. In the case of T-bonds, I don't think it's sustainable. I think it could be very sharp because I think T-bonds are now a bear market, meaning higher yields. But they have room for about a 10-point rally, in my view, which is a horrendous big rally. So if you're short based on long-term stuff, you got to be careful. We warned our subscribers about that. Though we're bearish, there could be a very sharp rally, and that would fit with a sharp stock sell-off. In the case of gold, it's different. The pullback is within the context of a longer-term bull market, not in the context of a new bear market. I don't agree with the widening chorus of analysts, mostly Wall Street types, who think we're headed back down to the lows again. I think the dollar has confused them. The dollar punched out above a pair of highs, the dollar index we're speaking of here, that had been at 100 and 100. That was in early 2015 and again early this year. We punched out, as we expected in our reports, by a few points, got to 102. Right now it's back under 101, slipping off again. Our view is that breakout was probably false. It was probably a bull trap. And that if next year, which is to say 20-some-odd trading days from now, if that dollar index is down at 98.5, it's over. We think that there could be a big bear market in the dollar. Now we're seeing the reverse type of situation in the euro and the yen, which are the two most weighted currencies in the dollar index. So the yen recently had a sharp break, so did the euro, as the dollar went up. But we think all those recent moves in those three markets were not the real move, that they were false moves. Now that would, of course, if we're right on that, if the dollar has in fact made a false, quote, price chart breakout and falls back into the high 90s again and breaks down hard at that point, that would, of course, assist gold.
Well, you mentioned, I think, 98.50 for the dollar on the index. If again, when you come up with these numbers, prices for different markets, but underlying that is always a momentum.
Correct.
Your momentum work, right? So,
yes,
for example, for example,
we go to 98.50. If you look at a price chart, that may not mean much.
Yeah, right.
But when you look at an annual momentum chart, measuring the dollar index, let's say, against a 36-month average or 3-year average, you're breaking a trend line that goes back years.
So you're breaking a structure. You're breaking through the bottom of the floor, essentially, that says, whoops, I just fell through the floor, and there's nothing to catch me for a while.
Correct.
Yeah. So, for example, a really good guy, a good analyst, I think, but based on price, he's looking at gold. He made the statement a couple of weeks ago that if we break 1,200, he said, look out, we're probably going to be heading for a round trip, meaning that we'll go back to the lows that we had before this breakout, before this major move. I guess 2000 and what did we have? 2015 was pretty nasty.
We were in the 1040s, yeah. Mm-hmm.
Right. So he's looking for a return trip. He says a double bottom, and he's bullish longer term, but he says that's where it's going. Now, he doesn't look at the momentum, structural momentum type of analysis that you do. I think he's looking at just price, so he doesn't see it.
Well, I respect it, but I do momentum work, and momentum tends to cut down on error. Put it that way. Price charts are often misleading. Why? Partly because everybody sees them, and if everybody sees it, Joe Granville had the famous quote: "If it's obvious, it's obviously wrong."
Yeah.
And when a price chart is clear to everybody who just glances at a price chart in a financial newspaper and draws a little line with their crayon, it can't always be valid, because if it were, we'd all be rich, right?
Right. Oh, okay, that's right.
Sometimes the trend line breakouts you see are crossing some favorite moving average. It's just noise. And so we look at the gold on various time scales of measurement, but in particular on annual and quarterly momentum, which is to say long-term momentum. This is a pullback in a bull trend, period. You have not broken anything other than scared the heck out of the price chart, folks. Mm-hmm. But in terms of destroying the integrity of the positives that were generated in February when gold came up through 1140 and broke out on annual momentum, you've not done anything to offset that. You've had a sharp pullback, but natural gas, you mentioned a while ago, for example, we had that buy at 240, it went up to 330, and it pulled all the way back to 255. That's a huge percent drop. I mean, you measure from 330 back to 255, that's probably bigger than the gold drop we just had. But in a matter of 2 weeks, natural gas is back making a new high. Mm. Oh. So, price can be very deceptive.
Yeah, but the structure kept you in there and kept you long, and even though it might not have felt good,
hang in there, right?
Yeah, very interesting. Well, when do you think, Michael, we might see some separation? You said the bonds and gold are trading together. It would seem to me that if we were heading into some sort of an inflationary environment, you would see possibly gold in a bull market and bonds in a bear market.
That's right. I agree with that. And I think you will. I think all we have pending in the T-bond market, T-bond futures we look at, when they go up, that means yield goes down. They've had a horrendous drop over the last few months, from in the 70s, 170s, down into the low 150s. Big drop. Right now we're about 153, 154. It wouldn't surprise me to see 160 again. From the low, that's a big rally. But it's it's a short covering rally. It might be the type of rally that would be associated with a stock market sell-off that sparks, again, flight to safety. And I think it's the kind of rally in T-bonds you want to short. But right now I think the potential for that rally is pretty good. As big as that sounds, it really doesn't get it back anywhere near the highs. It doesn't alter the damage that was done, because our sell signal came at the 166 level. So rallying back to 160, while it's a nice rally, it doesn't even threaten the original entry level on the downside. And it's just like the gold sell-off now. Is it really bearish, or is it just a sharp sell-off in an uptrend? The same can be said about a T-bond rally. Now, where do I think they'll separate? To some extent, I think they already have, except on a short-term basis. They're linked. But I would suspect if bonds will get that rally and get up into the high 150s or 160, at about that point in time, bonds should then roll over again, and I bet that it then separates from gold after having had that rally.
Yeah. Well, that's just it would certainly make a lot of sense if it went that way. You're still very bullish long term on commodities in general, right? Yep. So that would go with your weaker dollar.
Right, it would go with the weaker dollar. That would assist the commodity upturn. And even with the pullback we've had in the Bloomberg Commodity Index this year, from the high of the year, that is, it's still up much more than the S&P is on the year. And people tend to forget that. They say, oh, look, commodities are doing nothing. Well, admittedly, half the commodities are doing nothing. The eating commodities, the food commodities, meats and grains, are still near their lows. So they've not participated yet. And we think next year they're going to be the stellar, probably the outperforming half of the commodity complex, instead of it being oil, which is outperformed this year relative to grains, let's say. And certainly gold is outperformed versus the grains. It's next year, I think the grains could really come from behind and help boost the commodity index. So the stuff you eat is going to matter next year.
Oh, well, that's not a good thing for average folks, that's for sure. It's very, very disconcerting. Right. As David Stockman was talking in an article he wrote yesterday, I didn't get a chance to read what he wrote today, but very disconcerting to him that he's losing hope that Trump is going to make much of a difference in terms of his monetary policy. It seems as though he's probably not going to have the intestinal fortitude that David Stockman's boss had in allowing Volcker to raise rates and allow the interest rates to go where the market would take them. It seems as if anything, Mr. Trump may be looking to just gun it, just goose it, and maybe that's what your market's seeing there, and your momentum work is suggesting.
Let's assume the best. Let's assume he's going to do the things that we might like to see, or undo some things we might like to see undone.
Right.
Even if that's true, it takes time for things like that to have an effect. Let's say he cuts taxes sharply for business, for example. That's not going to be an instant cure. It might take a year and a half or so before that sets in and has a measurable impact. And there's a lot of negatives that are built into the system now, pricing errors in various markets caused by 5-6 years of central bank excess. That probably will trump, anything positive that Trump might do. Because, you need to have the cleansing before you can have the upside. I think it even happened to Reagan, Things turned around during his administration, but there was a very sharp 22% drop.
Oh, yeah.
His post-election high until 1982 low.
Yeah.
So,
that was exactly Stockman's point, that Reagan left it happen early in his administration, sort of cleansed the system, and at least to a degree, allowing then for some very substantial capital formation and not all this malinvestment and horrible pricing, lack of price discovery in all manner of markets, starting with the, I like to say that it's very difficult to have capitalism if you're not allowing price discovery of capital, right, Michael?
Absolutely. You don't have capitalism.
You don't have capitalism. They've taken it away from us. So
you have what Mussolini invented, which is the form of socialism in which you get to keep your deed. But that's all.
Well, if only the masses could understand, and if only our schools would teach how capitalism works and why it is the most just system, and the system that rewards good behavior and punishes bad behavior, or good results and punishes bad results, we would be so much better off, Michael. I know you do the best you can to educate people with your book. Tell the people your book again, the title of your book.
The title is The New Libertarianism, Anarcho-Capitalism. It's available on Amazon.com. It's a philosophical book, and it's not current. It's not filled with current news or anything of the sort. So it's very much an idea book. It's a fairly short book, 168 pages, but it's philosophical. So it's
it's philosophical it's philosophical, but it is time proven. I mean, it isn't time sensitive in terms of those philosophies, and the way human beings function and the way we work and the way we operate, that doesn't change with time. So I think it's a timeless book, actually, Michael. It's an excellent book.
Well, I hope so.
That is.
Thank you, Jay.
Have you back next week, Michael. Thank you so much for being with us.
Bye bye.